Hello everybody, this is Lara with your end of the week US oil video for the trading week ending Friday 10th of May. For US oil, I'm expecting a downward trend as in its very early stages, and my final target is now 10.72. I'm going to focus this week on trying to make my Elliott Wave analysis as simple and clear as I possibly can. The basic concept of Elliott Wave is simple. It's 5 steps up followed by 3 steps back. The bigger picture for my oil analysis sees a 5-step up pattern complete at this high here, and now a 3-step back pattern still unfolding, and I'm labelling that pattern Supercycle Wave 2. The complicated part of Elliott Wave comes within the corrections. Within the 3-step back patterns, there are more than 23 possible Elliott Wave structures, and so it's important to pay close attention to the rules and guidelines of Elliott Wave, but particularly the rules and what we call the right look. This pattern is labelled as a double zigzag, and they are fairly common Elliott Wave corrective structures, particularly for second wave positions. The first zigzag subdivides 5, 3, 5, and it's labelled cycle wave W. The double is joined by a 3 in the opposite direction labelled X, which subdivides as a zigzag. And here's the important part. If I've got this Elliott Wave count correct, then we should be expecting downward movement, and we can have an idea as to how it's going to subdivide, which tells us to have an idea as to how many bounces along the way we should be expecting. This wave count expects cycle wave Y to subdivide as a zigzag 5, 3, 5. And so now it's expecting primary wave C to be a 5-wave structure, which should subdivide 1, 2, 3, 4, 5. So there will be a couple of big bounces along the way down for waves 2 and 4 within the 5-wave structure of primary wave C. The target calculated here would expect primary C to equal 1.618 times the length of primary A, and that would see cycle wave Y move reasonably below the end of cycle wave W. The purpose of a second zigzag in a double is to deepen the correction when the first zigzag does not move price deep enough. This target would see that purpose met for cycle wave Y. When primary C completes cycle wave Y, then supercycle wave 2 would then be a complete Elliott Wave structure, and then this wave count would expect a massive trend change for oil and a new bull market, but we are not there yet. Cycle degree waves may be expected to last 1 to about 7 years. Beginning here, I am expecting this downward movement for cycle Y in its entirety to last from 1 to 7 years or so, closer to about 7 years. Let's take a look now at cycle wave Y at the weekly chart level where primary X ends up here. Cycle wave Y subdividing as a zigzag 5, 3, 5, and so now a 5-wave structure for primary wave C is expected to unfold 1, 2, 3, 4, 5, a couple of bounces for 2 and 4 along the way down. When it arrives, the first big bounce for intermediate wave 2 may not move beyond the start of 1 above the invalidation point. Let's take a look at how this is beginning at the daily chart level from the end of primary B up here, this point here. Primary wave C must subdivide as a 5-wave structure. There are only 2 Elliott Wave motive structures it can be, either an impulse, which is much more common and so much more likely, or an ending diagonal, which is quite a lot less common and so less likely. I will expect to see the most common, more likely structure until overlapping suggests I have to consider a diagonal. If we expect most common structures, then we, in theory, should be right more often than we're wrong. That's the approach to Elliott Wave based on probability. Intermediate C is expected to subdivide 1, 2, 3, 4, 5. The placement of these labels here is not exactly where I actually expect these waves to end. This is a rough guideline to show you the complexity expected. Trends don't move in straight lines. A downward trend will have bounces along the way. And this Elliott wave structure for primary C is expecting a big bounce for intermediate 2 and another decent sized bounce for intermediate 4. Within primary C, let's turn our attention now to the first wave of intermediate wave 1. It must be a 5-wave motive structure, most likely an impulse. At minor degree, I'll label that 1, 2, 3, 4, 5. Elliott wave is fractal. Let's turn our attention now to the first wave of minor wave 1. It too must be a 5-wave structure at minute degree labelled 1, 2, 3, 4, 5. Minute 1 and 2 may be over. Minute wave 3 has to subdivide as a 5-wave impulse. That's the only allowable structure for a third wave. So far, it may have minuet 1 complete. Minuet 2 may be very close to completion, and then this wave count will expect minuet 3, minuet 4, minuet 5 to complete minute 3. When the whole structure of minor wave 1 is complete, then a larger bounce for minor wave 2 may not move beyond the start of 1 above the invalidation point. When it looks like minor wave 1 is complete, I'll do 2 things for it. I'll draw a channel around it, and I'll look for a breach of the channel at the upper edge to have confidence minor 1 is over and minor 2 has arrived, and then I'll draw a Fibonacci retracement along the whole length of minor wave 1, and I'll use the 0.382 and 0.618 Fibonacci ratios as targets for minor wave 2 to end. But first, let's just look for the first 5-wave structure down to complete within this new trend of primary wave C. I hope that was a little bit clearer. Elliott wave, the basic idea is actually pretty simple. It's simple and at the same time kind of complicated. Okay, classic technical analysis. This is a lot simpler and a lot easier. This is the monthly chart. The last 3 months of upward movement have come with declining ATR. There's a little bit of weakness there. These 2 months here have long lower wicks. That's bullish. They also had support from volume. That was, well, this month did anyway. That was bullish. The last month completed for April also had support from volume. That's bullish, but contradicting that, now there is a long upper wick for April, which is bearish. The volume for April did remain below the first month here of upward movement, so overall there was some decline in volume. So a little bit of conflicting evidence there, but I'm going to give a little bit more weight to this long upper wick here. RSI is neutral. There's plenty of room for price to rise or fall here. MACD is bearish, but it's still above the 0 line, so not full bore bearish. On balance volume made a new high here, whereas price did not. There's some bearish divergence between the high of April and this prior swing high here on the monthly chart. I don't give that as much weight though as I do with on balance volume behaviour with its trend lines. That does tend to be a more reliable signal. At the weekly chart level, there was a strong fall in price here, and it came with an increase in ATR, and then price bounced and it came with a decline in ATR. ADX told us that this downward movement was a downward trend at the weekly chart level. ADX is still telling us at this stage that there may not be a clear trend. That is a lagging indicator, It's based here on a 14-week average. An increase in ATR with downward movement suggests there is strength within downward movement. Volume was pushing price lower. This is a strong downward movement. A decline in ATR with upward movement, and at the beginning some decline in volume, but the middle of it has support from volume. I expect that's a third wave. That suggests that this may be a counter trend movement. A bullish reversal signal at the end of this downward movement or candlestick pattern suggests a low in place, and now a bearish candlestick pattern at this high suggests a high in place, and we're getting a little bit of downward movement. For the very short term, this week closes as a doji, overall downward movement, a lower low, a lower high. On balance, volume moves lower. Volume is increasing this week, actively pushing price lower. The short-term volume profile I am reading, therefore, as bearish. Support identified on the chart. RSI is neutral, plenty of room for price to rise or fall, and stochastics returning to neutral after remaining overbought for a few weeks. The shorter term picture, downward days of recent movement have stronger volume than upward days, but price can fall of its own weight, and it can do so particularly for the oil market. I've noticed over the years it can do so for quite a long time. Price can fall quite a long distance with light and declining volume, because price can move lower due to the absence of buyers, just as it can due to activity from sellers. The short-term volume profile I'm still going to read as bearish. There's a little bit of a sideways consolidation here, possibly maybe a little flag pattern developing. Let's keep an eye on that. ADX is declining, telling us that at this stage there is no clear trend. On balance, volume is constrained. Let's watch this support line and then this one below, but particularly this new support line I'm drawing here. If on balance volume moves below that, it would be a bearish signal. This support line has a few tests. It's close to horizontal and it's reasonably long held, so that would actually be a reasonable bearish signal. This support line would not be such a strong bearish signal though, because it only has two prior tests. RSI is neutral. There is plenty of room for price to keep on going lower, and stochastics back in neutral territory. It looks like there's a high in place. There was a series of higher highs and higher lows until here we had a lower low below the last little swing low, and now there's a series of 2 or 3 lower lows and at least 2, possibly now 3 lower highs. It does look like there is a high in place for oil, at least for the short to mid-term. That's all from me with your oil analysis this week. I hope that all of our members are having a most fabulous weekend.